Geopolitical events have a significant impact on investments, influencing market sentiment, economic stability, and global financial markets. Here's an exploration of how geopolitical events affect investments. Market volatility. Geopolitical events such as wars, political unrest, terrorist attacks, trade disputes, and sanctions can trigger market volatility. Uncertainty about the outcome or potential economic consequences of these events can lead to fluctuations in stock prices, bond yields, commodity prices, and currency exchange rates. Risk perception. Geopolitical events often increase risk perception among investors. Heightened geopolitical tensions or instability in key regions can elevate perceived risks associated with investments, prompting investors to reassess their portfolio allocations and risk management strategies. Sector-specific impacts. Certain industries or sectors may be more sensitive to geopolitical events. For example, energy markets can be affected by geopolitical tensions in oil-producing regions, while technology companies may face regulatory challenges in global trade disputes. Safe haven assets. During times of geopolitical uncertainty, investors often seek refuge in safe haven assets such as gold, U.S. Treasury bonds, and stable currencies, e.g., U.S. dollar, Swiss franc. These assets are perceived as less risky and provide a hedge against potential market downturns. Impact on emerging markets. Geopolitical events can have a pronounced impact on emerging markets, which may be more vulnerable to external shocks and investor sentiment. Currency depreciation, capital outflows, and increased borrowing costs are common consequences for emerging market economies during geopolitical turmoil. Long-term investment strategies. Investors with long-term horizons may adopt a cautious approach during geopolitical events but often focus on fundamentals and economic trends. Long-term investment strategies may include diversification across asset classes, regions, and sectors to mitigate geopolitical risks. Policy responses. Governments and central banks often respond to geopolitical events with policy measures to stabilize financial markets and support economic growth. Monetary policy adjustments, fiscal stimulus packages, and regulatory reforms are among the responses aimed at mitigating negative impacts on investments. Sectoral opportunities. Geopolitical events can create investment opportunities in sectors benefiting from geopolitical shifts or policy changes. For example, defense stocks may rise during periods of increased military spending, while infrastructure investments may grow amid geopolitical efforts to enhance regional connectivity. Global supply chains. Geopolitical tensions, trade tariffs, or sanctions can disrupt global supply chains, affecting multinational companies' earnings and stock performance. Investors monitor supply chain vulnerabilities and adjust investment strategies based on geopolitical risk assessments. Risk management. Investors and portfolio managers incorporate geopolitical risk analysis into their investment decision-making process. Risk management strategies may include scenario planning, hedging strategies, and active monitoring of geopolitical developments to protect investment portfolios. In summary, geopolitical events exert a profound influence on investments by shaping market sentiment, risk perception, asset prices, and global economic conditions. Investors navigate these challenges by staying informed, diversifying portfolios, and adapting investment strategies to capitalize on opportunities while managing geopolitical risks effectively.